Hi, I'm Ilya from Near, and with me David from MakerDAO, who will tell us more about how to keep stable.
Yeah, sure. So if you guys aren't familiar with Maker, MakerDAO is a decentralized credit facility. So the main product it creates is the DAI, right? This little triangle.
Actually, maybe before that, do you want to tell about yourself a little bit?
Oh, actually, sure. That's a very good, and this is a bad DAI symbol anyway. So I'm David Utrobin. I do community development at MakerDAO. I do a lot of educational resources that I make available to the community. I help with the grants program that we're running, and basically I'm a huge Maker nerd. So hello, and please bear in mind that I am not extremely technical, but I do understand the granular details of the system, and I'll do my best to ping pong back and forth and give you guys hopefully a better understanding of how our system works. Cool. So I think the best place to start is to understand that the main product Maker currently creates is the DAI stablecoin. So DAI is a soft peg stablecoin to the US dollar, and it's great because it is created and destroyed in a very novel way. So the main smart contract that Maker created is called a CDP. So it's called a collateralized debt position. You could think of this as a bank account, right? Like you could think of this as just a balance of a couple things. So the way that you interact with the CDP is you basically can mortgage your ETH. So if you have Ethereum lying around, you could use it as collateral in the system. So let's say this is $1.50 of Ethereum. I'm going to use very low numbers to explain a couple of things. So if you lock $1.50 of Ethereum, the maximum amount you can borrow against it is $1. And this dollar is the DAI stablecoin that you get, right? Sorry for drawing a really shitty DAI symbol, but it's okay. So the idea behind this is the maximum amount that you can get because there is a loan to value ratio of 1 to 1.5 at a minimum. So if you're familiar with Maker, we call it a collateralization ratio. So this is actually 150% over collateralized. So what this means is for every dollar that you borrow, you have at least $1.50 of collateral backing it. And what happens when this $1.50 turns into $1.49 is the system does something very special. So it actually seizes your collateral, right? Like it takes it, and it will take your debt, your $1 of debt, and it will add to it a 13% liquidation penalty. So if you get liquidated, if you fall below the loan to value ratio, the system actually will charge you your 13% on your debt. So it'll charge you $1 plus 13 cents, right? So it'll take your collateral and it will give it to the liquidity providing contract, which basically takes the price feed for Ethereum, and it takes your it takes your collateral and basically makes a calculation on how much it needs to sell for this 3% discount to cover your loan and to cover the penalty. So I'm trying to be neat with the diagram here, but here, let me do it like this. So the liquidity providing contract, it interacts with the oracles.
Well, it's more like oracles pushing into it, right?
Well, exactly. Well, the liquidity providing contract, it takes the ether, right? Like it takes that collateral, actually not an S, like a little Ethereum logo, right? So it takes the Ethereum and it makes a calculation so that it can basically sell enough to cover your $1.13. And then whatever excess collateral is left over, maybe like 20, 30 cents, the CDP holder gets it back. So they get to actually keep this dollar, and they get to keep whatever little bit of leftover collateral there is.
Is it in Ethereum that they get it?
Yeah, exactly. So they get to keep the dollar, whatever they did with the dollar, whether it was buying more Ethereum or transferring it to US dollars through SendWire or whatever it might be. They get to keep, they don't have to pay back the loan after they've been liquidated, because they already did pay back the loan with their collateral, because the system seized the collateral and made sure that recourse happened so that their loan never ever actually went insolvent. Yeah, so that's the very, very most basic thing that MakerDAO creates. It creates the system where you can lock up collateral and borrow against it. And yeah, so
a few questions.
Sure.
So this contract, right, how does it know when to pretty much start liquidation process?
Sure.
It also takes the Oracle information?
Absolutely. So do you mind if I erase this?
Yeah.
Cool. All right. So let's talk about oracles. So oracles are a lot of fun because I just wrote a nice FAQ on them. Oracles, right? So for those of you that don't know what oracles are, oracles make off-chain data available as inputs for smart contracts on-chain. And MakerDAO, because it'll actually tell you how much DAI you can generate, and it has to actually know the price of Ethereum in order to give you a loan, it needs price feeds, right? So it needs the US dollar value of ETH. It also needs the US dollar value of MKR. And for our system, those are the only two we focus on. But Maker actually does provide oracles for, I think, Poly, for Augur, Augur's rep, and etc. But MakerDAO did something really cool with oracles, and they tried to solve the issue of manipulating the actual reference price. So imagine you have the Ethereum price, and somebody reports that it's 0. That means every single CDP on MakerDAO is going to get liquidated, right? Because everybody's loan to value ratio is like fucked up. Excuse my language, right? And likewise, if somebody takes the Ethereum oracle and misreports the price as 10,000, that means they can issue as much DAI as they want. And unfortunately, the DAI is not actually going to be backed by crypto collateral or any collateral. It's going to be fraudulently issued. And that's a huge, huge, huge issue because that compromises the integrity of the peg. So how do MakerDAO oracles work? Well, I'll make this a little bit better. Well, for ETH, there's actually 14 different, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, just to give a visualization, right? 3, 6, 7, 8, 9, 10, 11, 12, 13, 14. So there's 14 different individuals. For single collateral DAI, they actually chose several people from the Maker Foundation, a bunch of people from like old school BitShares community, and et cetera, but the identities of these people are not actually known by the public, and they're known by a very small handful of people. But they're mostly people that are trusted and are looking forward to, the security of MakerDAO. So what do each of these guys do? So, let me take a breath. So each of these guys run a program called Setzer. And Setzer is basically a program that plugs into several different exchange APIs and pulls a certain price feed that you ask it. So each one of these people are pulling from like multiple exchanges, right? So, and each one of them, if you look at just one of them, this guy, he's gonna have a set of prices, right? Like he's gonna have 121, 121.50, 122, et cetera, right? Each one of these are going to have a bunch of these sets of numbers, and what they're going to report to the medianizer. So what they're going to report to the medianizer. So the medianizer is the main oracle, the main smart contract that actually publishes the reference price in the MakerDAO system. So what they're going to do is they're going to take the median. Every single one of these 14 are going to take the median, and they're going to push it to the medianizer.
Do they do like outlier removal kind of thing?
That's why it's a median and not a mean. So if it's a median and there's an exchange that, let's say, is reporting the price of Ether
500.
as 500, or on the other side, right, like they're reporting it as 1 cent. Those things are not going to matter. So the only time you could actually influence any individual price feed provider is if you can basically mess with either all the API exchange data or hack them and basically like implant like a false set of numbers. But the beauty is, even if you corrupt one of them, you actually have to do a lot more to corrupt the medianizer. So the medianizer, sure, ask the question.
Is the exchanges known that provide this information?
Yes, so they vary in between, but so Maker provided Setzer on their public GitHub repo, so anybody could run it and change what APIs they plug into.
But I mean, like,
there's a lot of overlap, yeah.
So pretty much if somebody goes and hacks
one exchange or like
few exchanges,
yeah, absolutely, they can mess with that number, of course. But the other advantage of having multiple feed providers go to the same API is because if the API is not hacked, but instead it's the feed provider that's being hacked, you know that they're being hacked because everybody else is reporting a correct and consistent price. Exactly. So as I said, all these guys take the median, and the medianizer, guess what it takes? It takes the median of all the medians. So exactly, you have a set of numbers, right? 120, 121, 122, doesn't matter, right? 122.50. And this list is obviously a lot longer. There's going to be 14 different numbers, and it picks the middle. And the reason for that is, again, because if you took an average, the mean, that means that outliers can actually significantly influence the reference price. Now, how often does the medianizer update? So the medianizer updates anytime the mean changes. So each of these feed providers, their Setzer is configured to basically report a price if it changes by like 0.5% or something like that. Don't quote me on that because each person can actually choose to change that variable. But basically, whenever they push an update to the medianizer, or poke it, actually, that's the actual call in the smart contract, they poke the medianizer, and the medianizer gets updates its internal set of numbers, and when the middle number is different, it actually does a transaction and publishes this price as the reference price for ETH in the actual system. And this is the price that the CDP uses to calculate everything from the collateralization. Well, yeah, the collateralization ratio of 150%, right? Like it's based on that. There's also the, I guess the stability fee is not contingent on it. Debt ceiling is also not, but really it's the loan to value ratio because.
Well, it's also a decision when you actually start.
Well, also, yeah, exactly. And it's also like how much DAI can you actually draw. Yeah. It's also when do you get liquidated, yeah. Right? Et cetera, et cetera. So it's a very important price to basically keep track of.
So the question here is, do you know how much this guy is spending on pretty much gas pushing these things?
Absolutely. So each one of these is a transaction fee. Like it depends on the day, right? Like the network goes through seasons of congestion and seasons of no congestion. So this is actually a very heavy model and it doesn't scale because for one single price update, it requires 15 different transactions. In multi-collateral DAI, this whole system is completely changed. Not completely, but all of these guys, they actually use secure scuttlebutt to sign messages and report to the medianizer off-chain, and then the medianizer just has to publish a single reference price every time the same thing happens.
So you pretty much run a site like a...
Off-chain, through scuttlebutt.
Yeah.
Do you know what scuttlebutt is?
No.
So scuttlebutt is like a encrypted secure messaging protocol. Mm-hmm. It's a way to sign messages and cryptographically ensure that they're private and send them around in a private network. But it's really, really great because it essentially functions almost the same way in a blockchain as a blockchain, but there's no like transfer of value, it's just transferring messages. So yeah.
All right, cool. And so like when I push a transaction, medianizer just puts it in the queue and then averages out later, right? It's not
exactly
like updates it every time somebody pushes.
It updates it if somebody pushes a price that changes the median. Then the median gets updated. And I'm like 90% sure of that, so don't like 100% quote me. But I'm pretty sure that that's how it works.
I'm just interested what kind of like front running things you can do on this where you know, if somebody's pushing a price that is changing the median, and you actually like pretty much kick them out of the block.
Absolutely. So all of these 14 guys are whitelisted, right? Like if we recognize, if we go and like analyze the price updates and we see somebody's intentionally like misrepresenting a price or trying to like manipulate something, we could fork them out or remove them. Yeah.
I mean, like you can actually like, this guy is saying, oh, price changed, I'm pushing my update.
Yeah.
And somebody just like pretty much fills in the block with higher gas.
Oh, to like try to
try to postpone the update, right?
Right.
So this, you know, you have period of time when this is not in effect, and you have like a arbitrage mechanic, like timing.
So I'm thinking, if you're just blocking a transaction, you still need to rely on somebody to publish a fraudulent transaction, because if you're not, like, let's say like 3 of the feed providers are down, their servers are just down, and now we're relying on 11 instead of 14. It's kind of arbitrary because they're still all, you know, like now you don't have to manipulate 7, you just have to manipulate like 6 of them to really change the median.
No, I mean, let's say you actually have everybody online.
Okay.
And the price changed, right? There's half a percent up.
Okay.
Right? So these guys want to update.
Yes.
What you do is, for a period of time, you just fill in the blocks with your own transactions.
Yeah.
Just with no operations. Right? They just pay a fair bit of money to do that. So for a period of time, Maker thinks the price is, you know, 120, when in reality, like, Oracle
might be already 120.50 or something.
Yeah, like one, you know, let's say it's changed like dramatically. It's like 125, right? So this is real price.
Right.
So you have, like, I have a time period where I can like collateralize some stuff, get in, and then I unlock it. I stop doing this. The price changes. It like, I mean, I didn't do like math on like how much you can make like this, but
I don't think you can actually make much, and I'll tell you why. Because so there is this thing called the OSM, which is let me write this here. So there's the Oracle Security Module. So the Oracle Security Module actually creates a delay on only the Maker price feed for now, but that's because there's reasons why it can delay the Ethereum price feed. But the Oracle Security Module basically makes it so that Maker holders can vote to change this number, but it's set to be a 1-hour delay on any price update. So what that means is if you have basically somebody monitoring what the oracles are reporting to the medianizer, if you see some malicious attack or DOSing or transaction block or whatever it is, you have the ability to either replace the feed provider and like use a different server, like get on the cloud, do something, or just like fork them out and like rely on everybody else. If somebody's attacking all of them, then this 1 hour gives you a chance to basically do emergency shutdown.
Wait, so this is 1 hour always? The price is delayed by 1 hour?
Yes. So the reason, I remember why Ethereum is not delayed. So because, remember I mentioned the liquidity providing contract that seizes the collateral and sells it according to the Oracle price, it actually needs a real-time price. So in multi-collateral DAI, this mechanism is changed. It's replaced by the auction mechanism, which doesn't rely on an Oracle because it's actually its own price discovery mechanism. So the reason why there is no delay on Ethereum now in single collateral DAI is because of the way that collateral sales work through the liquidity providing contract. But eventually in multi-collateral DAI, it will also have a 1 hour delay. And what that basically does is it gives people a buffer, and there's actually no downside to it. There's only upside. So from the perspective of the CDP user, they have an hour to basically, if the price is dropping, they have an hour to add collateral, to pay back, right? And on the the downside, like if you try to think of a downside, what happens if Ethereum goes up? Technically nothing, because you're still dealing with the lower price, so you can't actually draw more DAI. I mean, you can in anticipation, but there's really no way to like profit from it because you know where the Ethereum price is, and you can't really I don't really know. I think I'm explaining it incorrectly, but there's no real downside that I see that anybody has been able to like really explain to me. Yeah.
All right. Yeah, let's talk about the liquidation thing because that's the interesting part.
The auctions?
Well,
Like
explain how it works right now and then how it will work with
So let's get rid of all of our oracles.
Or yeah, I mean specifically actually like starting from. So right now, let's say.
Right now, what happens, right?
Right now, yeah, and what? So I have a CDP, right, which is under like, as of Medianizer updated, it's under the collateralization ratio. Who is actually putting it into liquidation? Like, how does that work?
Sure. Okay, so let's take example of a CDP, right? CDP, since we're in Colorado, number 420, owned by Rick Berman. So you better retweet this, Rick. All right. So CDP 420 has, let's try to do an easy number, $150 worth of ETH, right?
Maybe just try to ETH because, like, it's just.
Yeah, make it neater.
Yeah, let's do this 150 maybe.
Yeah, sure. Let's do this as one. Yeah, I like that better for conceptual.
And then you have like 1 ETH, yeah.
And then you have 1 ETH locked as collateral, and you borrowed against this 1 ETH 100 DAI. So as you can see, your collateralization ratio, right? So let's do that. So your collateralization ratio is actually right at the precipice because this is worth 150 and you're at 100 DAI, so your loan to value ratio is 1 to 1.5. So you're at exactly 150%, right? Did I just do that backwards? I don't fucking know. All right. So collateralization ratio is 150. So what happens when the next Oracle price is $148? Guess what? Your collateralization ratio becomes 148%, right? So 148%. And what this means is in the system that makes anybody able to call the byte function.
Oh yeah, I have an off-topic question. Sure. What's up with all the names?
It's a whole lexicon. You got to be part of the club, man. No, but flip, flap, flop, bite, yeah. Poke. It's like short names that like if you read through if you recognize like what they mean, it actually all makes so much sense. It makes it a lot more simple if you're like really looking at what it does. But a byte is a fancy or maybe a simplified name for liquidation. But basically anybody can go and bite your CDP, right? Your CDP, right? They can bite it. And what happens when they bite it is so the collateral, your 1 Ethereum, it goes through a calculation. So if right now the liquidity providing contract sees that you're unsafe and says, okay, you owe 100 DAI and the liquidation penalty is 13%. So it says, okay, I see that you borrowed 100 DAI, but I need to sell your collateral to cover actually 113 DAI. And what it does is it queries or looks at the Oracle price of Ethereum. It says, okay, so it's $148 per Ethereum, and I need to raise $113. So I don't want to do the math here, but let's say it takes like 0.85 ETH to cover $113, right, approximately. So it'll seize the 185 ETH, and it will offer it for sale through the liquidity providing contract. So this Ethereum will now be purchasable for a 3% discount. Wait, whatever, you know what I'm saying. Discount from the Oracle price, so from this price. And that basically gives keepers or independent agents that are looking for a quick buck a very risk-free profit because you could actually do the bite the purchase in a single atomic transaction as we have been seeing in our system. So that's basically how it works. But the liquidity providing contract relies on this price real time. Yeah.
So when they do buy it and the purchase, pretty much you attach DAI to the buy it, or how do you buy it?
I'm not sure how to actually craft the transaction, just because I've never done it myself.
How do you in two transactions? Well, I mean, like, let's say it's the buy it, it's in the liquidity providing contract. How do I buy this?
You can there's a contract call to buy it, but you can also buy it like from I guess the DAI.MakerDAO.com like old front end. You could actually click and like physically like buy it yourself if you're not running like a script to do this.
No, but what are you buying this with? Like, is this with DAI?
Oh, with DAI. Yeah.
DAI.
Okay. All right. So next part of like this process, right? So this 0.85 in ETH, somebody is gonna purchase this for 113 DAI, right?
So discount should be 110 or whatever the 97% of 100.
I think I'm not sure if it factors it in before or after, but basically it's trying to raise 113 DAI.
I see. Okay.
Right? So like it'll sell as much Ethereum to get 113 DAI. I don't know if it always gets it. I'm actually a little bit muddy on the details here, but think about it as does it like good enough to raise 113? Mm-hmm. So what happens to this 113, right? Number one, 100 of it gets erased from the supply. And the reason for that is because you actually created it here, right? So the accounting, it basically closes out your bad loan. Now you have $13 left, and this $13 in single collateral DAI is actually used to purchase PETH. And that's a whole different mechanism that we could talk about. And actually purchases it, and burns it. So no more PETH. But so it purchases it and burns it, and the reason for that in like a succinct way is actually PETH holders, anybody who's a CDP user has to convert their Ethereum into PETH, and they actually have a larger claim now of the underlying collateral. So they actually profit from the liquidity penalty. But in multi-collateral DAI, this is actually going to be profitable for maker holders instead. Yeah.
So why was there PETH in the first place?
So I think it was to get the minimum viable product out for single collateral DAI, and it was basically like a shortcut maybe, but I'm not 100% sure. If Nick was here, he'd probably explain it better, but I don't have a good answer for that.
It does feel like this should be buying maker.
Exactly.
That. Yeah.
Exactly. Yeah. But for this iteration of the system, it's buying and burning PETH. So CDP users actually get to profit. Yeah. So yeah, that's basically how it works right now.
So this is if you get liquidated, right? How do you close it yourself? You just put back the 100 DAI?
Yeah. If you want to close it before it gets liquidated, you pay back the 100 DAI plus the stability fees. So whenever you get liquidated, the stability fee is actually not taken, so maker holders lose out on liquidations actually, because the stability fee is not collected. But that's also something that's fixed in multi-collateral DAI. So 100 DAI plus, let's say you had this open for a year. At the moment, the stability fee is 1%. So you'd pay 101 DAI. And so the $1 goes to purchasing MKR and burning it, which reduces the supply of MKR.
All right. So where is, in theory, this one? Let's say when this thing just started, right? Mm-hmm. Opened one CDP, and then I want to close it right away.
Sure. So actually, this $1, it's denominated. The stability fee is denominated in DAI, but originally, up until like 2 weeks ago, you can only pay it in MKR. So you actually didn't have to deal with the math behind keeping the accounting of the supply of DAI intact. So what you do is you purchase Maker. Now, actually, in our CDP portal, you can do the same thing with DAI, But the cool thing is, in the back end, what happens is it takes the DAI and it actually swaps it for Maker. And then it sends the Maker to burn.
How does it swap? Is there like a balance of
I think it
Maker?
uses either Kyber or Oasis, but there's some pair and it just does a transaction, a market, like a limit order or market order, probably market order, yeah.
Okay, cool, yeah. So this is a pretty much current model, and then
this is the current model, yeah. So the couple of weaknesses are the fact that this $113, I'm not sure if it's guaranteed. Maybe sometimes it might raise like 112 if like the value, like if it calculates 85 ETH to get 113, but in the time that somebody like actually buys it, maybe the price of ETH falls another $1, it might raise $111 instead. But that's okay because it's raising a surplus, and the real thing that you actually have to worry about is this 100. It has to raise the 100 so that it can cancel out your debt that's in danger. The 13%, that's extra, that's just an incentive.
So if let's say it, calculate 113, put it in the market, but the price went down even more, right? Mm-hmm. What's the probability of it going under 100?
Well, it depends on the velocity of the downward price action, but if this 0.85 can't cover 100, what actually happens is PETH is minted and it's used as the recapitalization source. So it'll be minted and sold for whatever leftover DAI it needs. Yeah. So in single collateral DAI, not a lot of people know, but Maker is never burned. Maker is never actually issued. So Maker as the lender of last resort is actually only going to be in multi-collateral DAI. Right now, the lender of last resort is PETH holders. And for some fun numbers,
what is PETH again?
PETH is pooled ether. So let's explain PETH a little bit. See, I told you I know the granular details. So, all right. First off, there's ETH, right? Our favorite cryptocurrency. Then there's WETH, wrapped ether. And the reason you do WETH is because it's your C20, right? Yeah. And you can and you can interact. Yes. You can interact with smart contracts with it, right? But in Maker, you actually have to convert your WETH to PETH. And this is inconsistent. Okay, cool. There we go. So originally at the inception of single collateral DAI, the ratio of WETH to PETH was 1:1. Mm-hmm. And basically what this means is if over time the ratio changes because PETH is burned. So for every one WETH that you have, if PETH is being burned, then your one WETH, let's do this. This is the PETH. This is the WETH. So if the PETH to WETH ratio changes, right? So one PETH will earn you now 1.001, and then 1 to 1 point. Today it's like 0.4 something, right? Mm-hmm. So over time, the liquidation penalty actually creates, because it's burning PETH, you actually have more of a claim on the WETH. Yeah. Exactly. And then when PETH is created, it's actually the other way down. This ratio goes back down.
Yeah, so this is, everybody who is in CDP right now, they are in PETH, so if they...
Since they are taking on the risk of dilution of PETH, they get the reward for successful liquidations. And that's how it functions right now. And right now, PETH holders, there's not been a single dilution of PETH because there's never been a single actual event of insolvency in the life of our system so far. So PETH holders actually made a lot more than Maker holders. I think they made something like, the last number I read was like 4 million or 4.5 million spread across all PETH holders. Yeah.
What is the ceiling for this? Like how much can you...
Burn?
No, how much? Let's say, so right now, whatever Ethereum, I mean, for simplicity, 10 billion, right, market cap.
Sure.
What is the DAI for the current model, pretty much?
Sure. So
I mean, multi-collateral should just make it all great.
Well, the whole thing is there's a lot of things that you have to consider when you think about ETH as a collateral. So number one, you have to consider liquidity risk. So liquidity risk means, let's say right now there's 2% of ETH locked in our smart contracts, right? But let's say 5 years down the line, 10 years down the line, it's something crazy, and like Maker holders completely like screwed the pony and
took over the Ethereum.
And like it's like they just were like, you know what, we're gonna be super liberal, and they allowed like 80% of the Ethereum supply. Well, guess what? If 80% of the Ethereum supply is locked up, then anytime somebody gets liquidated and Ethereum needs to be sold, there's less liquidity on the market, which means that the sales are actually going to have more of an effect on the price of ETH and the slippage. So the more liquidity you have, the less slippage and the less risk of slippage during a collateral auction, right? So there's liquidity risk. You don't ever want to lock above a certain amount of supply of any given asset, because that's going to kill your liquidity and that's going to kill your recourse, right? So number two.
So what is the current
liquidity?
What is the current like limit or ceiling for this?
Well, it's really hard to quantify because volume data on exchanges is very unreliable, right? Unreliable. Okay, so this part, if you want to have a really good understanding of your liquidity risk and how much available liquidity there really is at the moment, which by the way can change, right? Like Ethereum liquidity could definitely dry up, or it can like become very, very ample. So the liquidity risk like value, like in the equation of like how do you define the risk of Ethereum as a collateral, it shifts with the dynamic market, right? So let me just clean this up a little bit. So there's volume, right? And that is just related actually to liquidity. So let's do it like.
Yeah, liquidity is, pretty much. Volume defines liquidity.
Exactly. So so this is actually going to be very interesting moving forward when people actually learn how to clean the data from the exchanges and differentiate wash trading from like real things. And even like there's just a lot of nuance with this. So there's liquidity risk. And so if you lock in like some maximum amount of supply, that's really bad. And the way you actually deal with this is you set a debt ceiling. So every single collateral in the DAI credit system has a debt ceiling. Currently, Ethereum's debt ceiling is 100 million. So basically, because we're being careful, we're limiting the amount of DAI that you can issue against Ethereum to 100 million. And if you consider the average collateralization of the entire system to be 300%, let's do some math, right? That means that you can have up to $300 million worth of Ethereum, whatever that might be. Yeah. So, yeah.
So this is like a number that just somebody set and government.
Yeah, exactly. This is what limits you from using 100% of the supply, right? It's just you are basically, because if you open this limit up, you're actually putting the Ethereum in danger. Exactly.
So what if you hit this limit? Yeah. Like DAI, pretty much you cannot issue more DAI, right?
So we did hit this limit before. So a little bit of a history lesson. The first debt ceiling was actually 50 million. And we hit that debt ceiling. And the cool thing is, so now it's like a good time to talk about short-term stability mechanisms for the actual DAI peg. So for any DAI pair, there's market makers. There's people providing liquidity, and there's people arbitraging and maintaining the peg. So what happens when you hit 50 million, right? Let's say there's this 50 million DAI. Let's say you hit it. Now your supply is at its maximum, right? It's at its like total maximum. But the problem is that what if demand is still running? So if the demand for DAI is more than 50 million, then guess what? Exactly, DAI is now trading at a premium, right? Premium, etc. Like it's trading at a premium, and this is a problem. But in the short term, if it hits the ceiling, you actually have some time because market makers will use this as a profit opportunity to basically reap the benefits of this premium. And then once their DAI inventory goes like really low, right? Like they only have 1,000 DAI, but they have 3,000 Ethereum. This is an issue for market makers providing short-term stability. So although if you hit it, it's not an immediate threat, it will reflect in the peg in some short amount of time in the short to medium term, probably in the short term. So if 50 million hits, you have to raise it, which we did. We raised it to 100. And this has been sufficient for now because funny thing is during a bear market, this is good. Actually, like the supply of DAI suffered a few 10% like downward spikes because there was actually like this guy, CDP 3228, everybody's famous, right? He had a $7 million CDP when the total supply of DAI was 70 million. So he held 10% of the supply effectively, and he got liquidated, which means that he actually paid like $900,000 in penalty that went straight to PETH holders, right? So thanks 3228, you made me a little bit more money. But yeah, so the debt ceiling is really not like like in single collateral DAI. If you hit it, you have no choice but to move it up.
But then why do you have it if you're moving it up anyway?
Well, I'll tell you, because in multi-collateral DAI, if there's DAI demand, right, you can shift the supply to a different collateral. So if there's like, let's say ETH, and let's say the second collateral is Digix, which it's probably, I have no idea if it is, but no, but seriously, right? So like, let's say Ether hits the 100 million mark, and like you cannot create any more DAI. So the supply is like capped, like it's kaput, right? Like kaput. So now Digix might have let's give it a very liberal amount for now because it actually does not have a lot of liquidity and there's not a lot of Digix around. But let's say there's 20 million of like capacity here. And there's only let's say 3 million of DAI
based,
of DAI debt, right? Of DAI issued against it. So you still have another 17 million of runway.
Yeah, so people will just start like selling Ether, getting Digix, pushing price down.
Exactly, and when you no longer have the availability to use ETH as collateral, what you're going to do is, okay, like what's my next bet? Like what's the next thing that I could do to get myself some DAI and to enter into a CDP and get that short-term liquidity? Maybe you have ETH and you sell it for Digix, or maybe you take your ETH and go to like Compound and like borrow some Digix or use Dharma or somebody, but you get your hands on some Digix. And now the system is effectively managing its portfolio of underlying assets. And using the debt ceiling, you can actually allocate certain percentages of the underlying collateral portfolio to certain collaterals. So it's a way of control, of not letting the liquidity risk overwhelm anyone.
But should it be market controlling this? Like, I mean, it's a portfolio, right? You're pretty much setting a limit on portfolio.
Exactly.
In somewhat artificial way.
Absolutely, but you have to, because if you don't and you let this run wild, you can actually collapse the asset. If people misuse it, if people really do.
Because you don't have you only have the ETH up, you don't have ETH down kind of mechanics in this.
And it's really the liquidity that suffers, and if the less liquidity, listen, if you have 80% of ETH. And you have a market downturn, a bear market, guess what?
Everybody gets liquidated.
And guess what? Once people start getting liquidated, that cascades because that's a sell order in the market.
People buying Ether.
So it actually creates like a very slippery slope. And that's why you see like these very sharp downward spikes at like the end of bear markets or at like the apex of bear markets, because you see all the shorts getting closed out and there's a liquidity squeeze. and then it bounces back and whatever. But basically, this is necessary not only for basically making sure that the collateral is not like suffering, but it's also important for diversifying the underlying collateral portfolio. Yeah.
Cool. So maybe we can get more into like how does a multi-collateral.
So we talked about the liquidity providing contract and how collateral sales work in multi-collateral DAI or in single collateral DAI today, but in multi-collateral DAI, there's going to be auctions. And auctions are great because no oracles. So, now you can have a delayed Ethereum price and you can have the benefits of having that security delay because you don't need oracles for the new auction system. So the new auction system, I'm going to try to explain it as best as I can, but I read about it a couple months ago and did my research on it a few months ago, so forgive me if I get some details wrong, but I'll do my best to explain it. So this is the part that I might get wrong, but there's flip, flap, and flop.
Yeah, I read some of Maker code, and that was the first thing I'm like.
Flip, flap, and flop.
There's tot, to.
yeah. So flop auction is where Maker is issued and sold. Last resort, right? A flap auction is something called a forward auction. I'm going to explain what that is. And a flip auction, if I'm not mistaken, is a reverse auction. I'll explain what all these things are. So the only part I'm not sure about is if I'm mixing these two up because I get a bit dyslexic, but I'm pretty sure flip is reverse because it makes sense, right? And flap is just the first auction. So let's take the example that we used before, right? Let's say that you have 1 Ether worth $149, and you have 100 DAI debt, right? Debt. So what happens when now you could let's do like what happens when you bite this CDP, right? What happens to your 1 ETH? So let's start from the forward auction. So sorry that I drew this in the wrong order, but this happens first, and then either this happens, B, or this happens, 1A. Maybe I should have wrote 2B or 2A. Yeah, that's probably better. Bear with me. So this is 1. This is 2A, best scenario, and this is 2B, worst scenario. So the first thing that happens is a forward auction. So the auction takes your full amount of ETH, your entire collateral, and it puts it up in a contract, and it says, bid on me. I need to raise 100 DAI plus penalties. So 1 ETH, I need to raise 113 DAI. So once everybody bids, and it establishes 113 DAI worth of bids on 1 Ethereum, the flap auction ends, right? It ends, and now the flip auction begins. So now it says, okay, I have your bids at 113 DAI for this 1 Ethereum. How little Ethereum are you willing to take for this 113 DAI? So now you're going to have bids saying, okay, I'll take 1.998. And you're going to have 0.990, right? 0.8.
Pretty much if you do price discovery from both sides.
Exactly. So number 1, it establishes the minimum amount to raise to cover the DAI debt and the penalty.
So if this did not establish, then you go to 2B.
Yeah, there you go. Exactly. So basically at the end of the flip auction, you basically take the 100 DAI, burn it, and then the 13 DAI you buy Maker and burn it. So that's basically how that happens. Now, let's say something else happens. you get bitten, and the flap auction occurs, right? And it says we're gonna give your 1 ETH, and we need to raise 113 DAI. And unfortunately, you only got bids up until $100, or like, you know, not even $100. Let's say something even crazier. Let's say like $98, or sorry, not 98 cents, $98. Now, this is not enough to cover your DAI debt. So what happens is there's a certain time limit on each auction. So if it does not raise enough DAI within the time limit, it actually, so this is where I need to kind of think for a second and get this exactly right, because I've been messing it up in my explanation for people. But what happens is it takes, I think it cancels out. Maker issued and sold. So the flop basically, I can't, the thing that I can't remember is, I can't remember if it honors these bids or if it completely cancels it and says,
let's cover this Maker.
No, you know what happens? You know what happens? I think that the person that that bids actually receives the ETH. Yeah. Right? So then, yeah, exactly. So yeah, exactly right. So then there's a balance of, right, like $15 that this thing has to raise, right? Yeah. So the forward auction raised some of the DAI, but not all of the DAI. So there's $15 left. And basically what happens is it says, I'm not 100% certain on how it establishes the first issuance of Maker, how much that is, but the flop auction will say like, let's say like, I'm gonna auction off, maybe it uses the Oracle.
Yeah, it uses the Oracle for the price and gets.
So yeah, so basically it'll say, it'll do a forward auction on the Maker. So it'll like put up, let's say 1 MKR, and it'll try to raise the 15 DAI. And so basically what happens is it says, here's 1 MKR, how much are you willing to bid for it? And so people say, okay, like I'm willing to bid 5 DAI. Willing to bid 10 DAI, willing to bid 14 DAI. And then eventually somebody bids 15 DAI. So I need to read up exactly on how the flop auction
why not just do a reverse auction? You say, I need the 15, like.
Oh, yeah. So, I need
DAI.
15 DAI.
How much Maker do you want for it? And then just issue that Maker.
Maybe that is how it works, actually. See, I did this like a couple months ago, so I'm a little bit loose on my flop. But, but yeah, so maybe it is actually a reverse auction that says we need to raise 15 DAI. How much Maker are you willing to take? Somebody says, I want half a Maker. And somebody's like, nah, what, half a Maker? That's way too much. I'll take a quarter of a Maker. And then like still like $15, a quarter of a Maker? Like you're getting like Andreessen Horowitz prices, man. I'm just playing. But basically, yeah. So you are right. It is basically a reverse auction that people are trying to basically tell the system how much DAI to issue, and they will give their 15 DAI that they're pledging.
So when these auctions run, do people actually bid with actual, like the transaction is actual bid that would be matched? Is it like on blockchain, or is it?
I'm not 100% sure if it's on the blockchain or if it can be like just like a signed transaction and there's like a single transaction that actually happens once a certain, once each like threshold is reached. So I'm not 100% certain about the details
like
of that.
Do you run a separate, like pretty much book, like order book or not pretty much?
Well, there's like gonna be
or it's all like order book is on blockchain itself.
Well, the thing is that the auctions is like not really an order book, right? It's just
well, yeah, it still can be like if people start like.
Yeah, exactly. It's instant, like it's sales through instances, right? So there's going to be all these different collaterals, and you know each collateral is going to be going through liquidations, and every time there's a liquidation, it always starts here. It always starts with, I need to raise 113 DAI, right? I'm going to offer all of your collateral, and if that doesn't work, I'm going to flop. And if I do raise it, you know, then I'm going to flip, and it's going to be a reverse auction. So, yeah. That's how auctions work in multi-collateral DAI, and they serve to be actually their very own price discovery mechanism.
So why not use this price discovery mechanism instead of oracles? And, I mean, feed it
or
back.
Or you can use it, you could feed it into the oracles.
Yeah.
So I think that I don't know 100% how to answer it, but I'll give you like my concern that comes to mind. What if there's a real consistent like 1 to 2% discount on this price, right? Because people participating in auctions are trying to actually arbitrage. They want to get the collateral, sell it, and then pocket like whatever 3 DAI every time they do this small of a CDP, right? So feeding it back into the oracle price, it's probably not going to ever be the median, but it will be an extra data point, I guess. So I don't know. I'm curious what Mariano Conti would say about this. He's actually at ETH Denver, so you should talk to him about that.
Sure.
But yeah, I think that's as far as I can go with flip-flop and flop auctions. But as you can see, it solves the oracle delay problem.
You have anything else you want to talk about, or?
I do want to talk about actually one thing, the stability of the DAI peg, right? So the DAI stability. What gives it stability, right? So you have to look at the short term and the long term, or the bigger, like the macro, right? For short term, you have market makers, you have CDP users, where if DAI is trading above $1, you're incentivized to actually create DAI because you get an extra % or half, like 50 basis points of purchasing power. This is actually good. When DAI is trading below $1, you can pay off your debt for a discount of like 50 or basis points to a percentage point or whatever it might be. So this is short-term stability. These main two incentives. There's the keepers, the market makers, who are like trading on like DAI pairs and trying to keep it at $1. And then there's CDP users who produce the supply or contract the supply, right? They can mess with the supply, and this is very short term. But long term, what happens when these keepers
try to drive the price?
Yeah, what happens if there's a imbalance in the macro supply demand function, right, of DAI? So the demand of DAI can go up in such a way that these two are not enough, right? So if demand goes up, then you need supply to basically compensate for that premium that you're going to see in the spot market. And basically how this is solved on a macro level is there's policy tools. And if you participate in Maker governance, this is going to be a good word for you to understand. So a policy tool is a parameter that Maker holders can change to basically manipulate the supply and then also manipulate the demand. So the policy tool for supply, do it like this, supply is actually the stability fee, right? So the stability fee, if you raise it, you are contracting the supply or preventing the supply from growing at such a rate. And if you lower it, you're incentivizing cheap capital costs, so you're actually helping people to increase the supply of DAI. So the stability fee gives you the ability to adjust the macro supply demand imbalance. Now, in multi-collateral DAI, there's also a tool for demand, which is the DAI savings rate. So the DAI savings rate is really interesting because it is a risk-free rate of return for anybody who wants to lock their DAI into this thing called savings mode. It's a smart contract that's going to be part of multi-collateral DAI. And if you do that, you get some small percentage. It's basically like a decentralized savings account, and it incentivizes you to hold DAI. So it's producing demand. So if you adjust this up or down, the net, sort of, if it's zero, there is no net loss in demand. But if you tune it anywhere up, you're actually producing like artificial like demand for DAI. So let's say that there's a lot of supply and a lot of like collaterals, and there's just like DAI is trading way below the peg. You can do something like the DAI savings rate, and that'll fix the long-term imbalance.
Wait, so this is like it just mints new DAI there in the
No.
savings, or
So
how
the
does it work?
stability fee, it takes out a portion from the stability fee. So
And feeds it into that contract.
exactly. So the stability fee is charged on all DAI in circulation, but the DAI savings rate takes a portion of the stability fee and pays it to whatever DAI is locked in the savings mode smart contract. Right?
And everything else is used to burn. Maker.
Everything else is used to burn Maker, and then eventually also it could be used for operational costs like paying oracles or paying risk teams. Yeah. So these are the two policy tools that Maker holders vote on. Over the last couple months, there's been a few votes on the stability fee because we're in like single collateral DAI and like this doesn't exist yet. And mainly, actually, like the biggest challenge is in the last few weeks, DAI has been trading slightly below the peg, which signifies an oversupply. So we raised it from 0.5% to 1%, and we're seeing kind of by 50 basis points at a time what that effect is on the peg. And that's kind of some of the data that the governance side of Maker, the community, is trying to gather and use for future decision. Exactly. Because this is brand new, and we only changed the stability fee like 3 times so far. So yeah, short-term stability, long-term stability. This is something that I think everybody who is curious about Maker should really understand.
And how does this feeds back? Like, let's say I am the Maker holder.
Sure.
Like for me, getting it to $1, how's that benefits me versus pushing the price up or down?
So from the perspective of like a Maker token holder, if the peg is consistently trading below $1, you know that your market makers are actually in danger. You know that in general your peg is suffering some sort of imbalance in the macro supply and demand. So you have to adjust for that if you want to keep your peg healthy, because you know what, the market makers have to go the other way too. They have to have more opportunities to actually sell DAI at above $1.
No, but what as a Maker token holder, why am I how am I incentivized for peg to be $1?
Sure. I mean, if the peg is not healthy, then your main product loses its integrity and value. So if USDC performs way better in terms of stability on its peg than DAI, then you're basically losing your market share and you're losing your confidence in what the product is. So you actually do need to actively manage the supply and demand of the peg.
But I mean, so if I increase stability fee, right, this actually benefits me as a Maker holder.
Yes, it does.
So why don't I just start slowly driving it up?
Well, because if you keep driving it up, then the supply is going to contract and the demand is going to keep growing because you can't actually control demand at the moment, and you're going to make the peg imbalanced. So too high of a stability fee is going to create too much of a block on supply.
But like short term, as a
way to make money?
As a Maker holder, I can actually if it's a rage quit strategy, right? You just increase this.
Well, thank God no one Maker holder can make this decision. The whole community has to agree.
What's a voting procedure on this?
Governance structure. So the voting procedure for this, at the moment, there's 2 types of votes. There's governance polls and executive votes. And executive votes doesn't mean like executives, it means like execute a change to the state of the platform, right? So governance...
So it just collects data and...
no, governance poll is more like soft consensus.
Yeah.
So it's meant to start off the conversation.
Yeah, like collect data about what people think.
Yeah, soft consensus. Do we want to raise the stability fee? Let's start talking about it. But then in the executive vote, there's just a lot more rigorous data backing up any proposal that's put forth. So you can imagine that the MakerDAO risk team that has been putting forth the proposal says, I'm going to put forth a proposal for, last week, a raise of 50 basis points in the stability fee. And our reasons are because we have communications and we know the largest DAI market makers, and they are they're basically about to be in a very bad situation in short term if we don't do something. Mm-hmm. And we also know that DAI is actually consistently trading. I'm not going to write it down. DAI is consistently trading below the peg for the last few weeks since we lowered it from 2.5% to 0.5%. Because recently it was at 0.5%. So the executive vote is going to say, okay, we want to have a healthy peg, also an increase in 0.5%, and doing it in 50 basis point increments is really great for data analysis moving forward. We think this is the best decision for the short term. It passes and the stability fee increases, and then we observe over the next week or two what happens to the peg. And this is the process right now for the stability fee. And it's going to work very similar to the DAI savings rate, and it's going to work a little bit different for adding collateral, removing collateral, and deciding on the risk parameters for all these different collaterals. So yeah.
Cool. Yeah, that's great.
That sums it up, right?
Yeah.
Cool.
It's pretty good. All right, well, thanks a lot.
Thank you guys for listening to me.
Yeah, check it out, leave some comments, give some feedback.
Yeah, and if you guys are curious about MakerDAO, visit our website, makerdao.com. Talk to us on Rocket Chat, on Reddit, Telegram. Google awesome MakerDAO. That's gonna send you to a really great GitHub repo filled with resources, podcasts, critiques, developer resources, also all of the tools that you can use your DAI with, et cetera, et cetera. But yeah, glad to have been here to explain things to you.